Your next tax bill is going to be different from your last one. Not because your income changed dramatically, not because you did anything differently, not because HMRC announced a new tax rate or introduced a new charge that you would have heard about on the news. It is going to be different because of something far quieter, something that has been happening in the background since 2021, that is now accelerating faster than at any point in the last 5 years, and that HMRC published official figures on just 2 weeks ago, confirming the scale of what is already happening to millions of UK taxpayers who have no idea it is coming for them. Welcome back to HMRC Update. Today, I want to explain exactly why your next tax bill could be higher than your last one, even though your situation feels the same. What changed, how it works, which groups it is hitting hardest right now in August 2026, and the specific actions that reduce the damage before the bill arrives rather than after. If you are not subscribed to HMRC Update, please do that now and hit the bell. This is the kind of change that does not announce itself with a letter. It arrives as a bigger number on a document you were not expecting, and understanding it in advance is the only way to manage it. Subscribe. Let us get into it. I want to start with a figure HMRC published 2 weeks ago that should have made front-page news and didn't. A record 10.2 million people aged 65 and over are expected to pay UK income tax during the 2026 to 2027 tax year. 10.2 million. The highest number since comparable records began. And the most important thing about that figure is what caused it. Because it wasn't a new tax. It wasn't a rate increase. It wasn't a policy change that anyone voted on or announced at a budget. The projections show the number of older taxpayers has risen sharply, despite no increase in income tax rates. Instead, a prolonged freeze in the personal allowance and higher rate thresholds has
meant rising state pension payments and other retirement income are increasingly becoming taxable, a phenomenon widely known as fiscal drag. The figures represent an increase of around 700,000 compared with the previous tax year. 700,000 more pensioners paying income tax this year than last year, not because they became wealthier, because the rules stayed still while everything else moved. And those 700,000 people are the ones most likely to receive a tax bill that looks different from anything they have received before, and to have no framework for understanding why. Here is how fiscal drag actually works, and why it is worth understanding precisely, rather than just knowing the term. The personal tax allowance has been frozen at £12,570 since April 2021, and this freeze is scheduled to remain until April 2028. But here is the more significant development. The income tax personal allowance and higher rate thresholds will now be maintained until April 2031, not 2028 as many people still believe, April 2031. The freeze was extended again in the autumn 2025 budget, quietly, without a headline, and the Office for Budget Responsibility estimates the total cost to taxpayers over the full freeze period will exceed £55 billion. The latest OBR estimate is that the freeze of income tax thresholds until 2030 to 2031 will raise over £55 billion in 2030 to 2031 alone. That £55 billion does not appear on a tax return as a new charge. It is collected through fiscal drag, through the gap that widens every year between frozen thresholds and rising incomes, pensions, and interest rates. The mechanism is straightforward once you see it. Your personal allowance is £12,570. It has been £12,570 for 5 years. It will remain £12,570 for another 5 years. Meanwhile, the full new state pension has risen from £179.60 a week in 2021 to £241.30 a week in 2026. Wages across the economy have risen with inflation. Savings rates have risen sharply. Every pound by which income rises above the frozen personal allowance is a pound on which income tax is now due, where previously it was not. Nobody announced that. Nobody sent a letter saying your effective tax burden is increasing this year. The threshold simply did not move while everything else did. For someone whose income in 2021 was £14,000, comfortably above the then personal allowance, paying basic rate tax on £1,430, that same £14,000 today would mean tax on £1,430. The same. No change in their tax bill because their income and the threshold were already misaligned. But for someone whose income in 2021 was £13,000, just above the £12,570 allowance, and whose income has since risen to £14,500 through modest pay rises or pension increases, they are now paying tax on £1,930 rather than £430, a £300 increase in their annual tax bill from a salary or pension increase that felt barely noticeable in take-home terms. That is fiscal drag, and it is happening across every income band simultaneously. Drop a comment below if your income has risen slightly in the last 2 years and you have noticed your tax bill going up by more than you expected, because what you are experiencing is not a rate change, and it is not an error. It is the deliberate effect of frozen thresholds working exactly as the government intended, raising revenue without announcing a tax increase. Now here is where the picture changes specifically for investors and higher earners in 2026, because 2 changes from April 2026 affect tax bills in ways that are separate from the threshold freeze, but arrive at the same time, compounding the overall effect. Dividend tax rates rose by 2 percentage points from April 2026. The ordinary rate is now 10.75%, and the upper rate is 35.75%. For anyone holding shares outside an ISA or pension who receives dividend income, whether from individual shares, investment trusts, or funds, every dividend payment above the £500 dividend allowance is now taxed at a higher rate than it was in
the 2025 to 2026 tax year. A basic rate taxpayer receiving £3,000 in dividends above the allowance in 2026 to 2027 faces a tax bill of approximately £269. Last year, that same dividend income cost approximately £213. The difference is not enormous on a single year. Across a portfolio generating £10,000 or more in annual dividends, the cumulative effect is very significant. Business asset disposal relief hits 18% in April 2026, a big shift for business owners planning exits. That is the relief that reduces capital gains tax on qualifying business disposals. It was 10% before October 2024. It moved to 14% in April 2025. It is now 18% from April 2026, with a £1 million lifetime limit. A business owner who planned their exit at 10% and waited, either for the right buyer, the right moment, or because they didn't keep track of the rate changes, is now facing a tax bill that is £80,000 higher on a £1 million qualifying gain than their original planning assumed. CGT main rates are steady at 18% for basic rate taxpayers and 24% for higher rate taxpayers on shares, property, and most other assets. Those rates were introduced in October 2024 and remain in place. The annual exempt amount, the gain you can make before any capital gains tax is due, remains at £3,000. That is down from £12,300 in 2022 to 2023. An investor who made a £5,000 gain on shares sold outside an ISA this tax year faces capital gains tax on £2,000. 3 years ago, the same gain carried no tax liability at all. Here is the part of this picture that most people do not connect, and that creates the biggest surprise when the tax bill arrives. These changes do not happen in isolation. Frozen thresholds, higher dividend rates, lower capital gains tax allowances, and rising income from pensions and savings all interact. A retired person with a full state pension, a small private pension of £3,000 a year, savings interest of £1,500, and investment dividends of £2,000 is not an unusually wealthy retiree. But their combined income and investment returns in 2026 to 2027 now generate tax obligations across 3 separate categories simultaneously: income tax above the personal allowance, savings interest tax above the personal savings allowance, and dividend tax above the £500 dividend allowance, where 2 years ago the same income and returns might have generated little or no tax at all. Fiscal drag is currently the greatest challenge for the private client. As wages rise to meet inflation, more individuals are pushed into the 40% or 45% tax brackets. For someone earning £48,000 in 2021, the higher rate threshold at £50,270 was comfortably above their income. By 2026, that same person, whose wages have risen modestly with inflation to £51,000, has crossed the threshold. Every additional pound of income they earn above £50,270 is now taxed at 40% rather than 20%. That is not a marginal difference. On income between £50,270 and £51,000, the difference is £520 in additional tax from the same earnings crossing a threshold that has not moved. Now here is what you can actually do about it, because understanding fiscal drag is only useful if it leads to action before the bill arrives. To counter the impact of higher investing taxes, consider using pensions and individual savings accounts, as both accounts shelter gains and dividends from HMRC. Hold investments that aim to pay generous dividends within pensions and ISAs, and strategies that focus on growth in your trading account, using your £500 exemption where possible. The ISA allowance for 2026 to 2027 is £20,000. Interest earned inside a cash ISA is completely tax-free and does not count toward the personal savings allowance. Dividends earned inside a stocks and shares ISA are completely tax-free and do not count toward the £500 dividend allowance. Capital gains inside an ISA are completely tax-free and do not count toward the £3,000 annual exempt amount. Every pound of income-generating assets
moved inside an ISA wrapper before the end of the tax year is a pound removed from the fiscal drag calculation permanently, not just for this year, but for every year the money stays inside the ISA. Pension contributions reduce your adjusted net income, the figure HMRC uses for most income-related calculations. A basic rate taxpayer who makes an additional pension contribution of £3,000 reduces their adjusted net income by £3,000, which reduces the income tax due, potentially takes them back below the point where savings interest becomes taxable, and may qualify them for marriage allowance if their income drops below $12,570. Each of those effects compounds. High-income child benefit charge traps more families as frozen thresholds pull more earners above £60,000. Check whether you are now in scope as a result of salary increases alone. If your income has crossed £60,000 for the first time this year, not through a dramatic pay rise but through modest annual increases accumulating over several years, the high-income child benefit charge now applies to your household if you receive child benefit. Additional pension contributions that bring adjusted net income back below £60,000 remove that charge entirely. Offsetting losses against gains remains powerful. Report all capital gains tax losses via gov.uk, even without current tax due, for indefinite carry forward. If you sold investments at a loss in the current or any recent tax year, those losses can be carried forward indefinitely and offset against future gains. An investor who crystallized losses in a volatile period of the market and never reported them to HMRC has left a future tax deduction unused. Report all losses through your personal tax account or self-assessment return, even in years where your gains do not exceed the £3,000 allowance. Check your tax code regularly via your personal tax account to avoid overpayments caused by frozen threshold interactions. As more people cross tax band boundaries, the point where basic rate becomes higher rate, or where income first becomes taxable, HMRC's automated coding system sometimes fails to reflect the new position correctly, either under-collecting through a code that is too generous, which leads to a tax bill later, or over-collecting through a code that is too tight, which leads to an overpayment that sits unclaimed. Your personal tax account at gov.uk shows your current code and the income sources driving it. Reviewing it now, in August, gives you time to correct it before the year-end reconciliation, rather than discovering the error in a P800 next summer. So here is the complete picture of why your next tax bill could be different and what to do about it today. A record 10.2 million people aged 65 and over will pay income tax in 2026 to 2027, 700,000 more than last year, not because of a new tax, but because frozen thresholds and rising pensions have crossed paths in a way HMRC projected and the government chose to allow. The personal allowance freeze runs to April 2031, not 2028 as many people still believe. The OBR estimates the total revenue raised by the freeze exceeds £55 billion by 2031. Dividend tax rates rose from April 2026, 10.75% at the ordinary rate, 35.75% at the upper rate. The capital gains tax annual exempt amount is £3,000. Business asset disposal relief is 18% from April 2026. The higher rate threshold remains frozen at £50,270. All of those numbers are interacting simultaneously with rising incomes, rising pensions, and rising savings rates. The actions that reduce the damage are available now. Move income-generating assets inside ISAs before the April 2027 year-end. Make additional pension contributions to reduce adjusted net income. Report capital gains tax losses through your personal tax account, even in years with no current liability. Check your tax code for errors caused by threshold interactions. And check your eligibility for marriage allowance and high-income child benefit charge.
Status: if your income has been rising gradually. The tax system did not change in a single dramatic announcement. It changed slowly, threshold by threshold, year by year, while incomes and pensions moved and the frozen lines stayed where they were. The cumulative effect of those 5 years of stillness is now showing up in bills that look different from what people expected, not because anything went wrong, but because nothing moved. Now you understand exactly why. Share this with someone whose income or pension has risen gradually and who has no idea their tax position has changed as a result. The understanding this video provides is worth considerably more than the time it takes to watch it. Subscribe to HMRC Update if you are not already here. I will